Investing is a bit like doing your weekly shopping. You know you've got to do it if you want a pension or put food on the table, but it's a real chore. In fact, investing is worse than shopping. When you pop down to your local supermarket, you've usually a good idea what you want to buy. In each area, there are a few brands and perhaps the store's own variety to consider. In investing, there are nearly 3,000 funds run by around 2,000 individual fund managers to choose from. Fortunately, there is a type of investment fund to help the busy or confused investor. It's called the multi-manager fund. It invests your money in other funds, usually between 10 and 20. It's a bit like finding someone who's willing to do your shopping for you. What a great idea! There are two types of multi-manager funds. The first is the fund of funds, which can, if it wants to, move quite quickly in and out of the funds it wants to buy. Think of a football manager selecting players for a squad. Most multi-manager funds are fund of funds. Then there's the manager of manager funds. This gives management contracts to a select group of fund managers who each look after a portion of the fund's money. A manager of managers funds can't drop fund managers as quickly as a fund of funds can, but its charges tend to be lower. It's a bit like the boss of a business who, instead of hiring lots of people, outsources different functions such as administration and marketing to specialist firms. Like supermarkets, all multi-manager funds take great care over what they buy. They aim to choose the best fund managers from different parts of the stock market, whose approaches will complement and work well together. Most multi-manager funds invest in unit trusts or open-ended investment companies, but there are some who also buy investment trusts and exchange-traded funds. Some multi-manager funds will only buy the funds of their employer. They are known in the jargon as fettered because they are restricted, although they tend to be cheaper. Most multi-manager funds can buy from all the funds that are available on the market, although they tend to be a bit more expensive. I've mentioned expenses a couple of times already. The fact is that multi-manager funds cost more than if you went to a supermarket and bought funds on your own. When you buy a multi-manager fund, you incur two layers of fees. Those are the multi-manager fund itself and those of the funds it invests in. Higher charges, though, aren't necessarily a problem provided you're getting something in return. When you buy a multi-manager fund, you're not just buying its choice of favourite funds. You're also buying its view on asset allocation, which is how it spreads your money between shares, bonds and other types of investment. Asset allocation is one of the most difficult things in investment to get right, so paying someone to do it for you could be a good idea. Multi-manager funds are divided into sectors whose names give you an idea of how much they can invest in shares. Here you see how much on average these funds made over 10 years to the end of May 2013. Multi-manager funds are never going to be among the top performers because of the way they spread investors' money around. But they are less volatile, which means they fall and rise less than other, more specialist funds. That said, multi-manager funds dropped between a quarter and a third in value during the financial crisis in 2008. They are not safe havens in that sense. However, they did bounce back. That's all I've got to say about the pros and cons of multi-manager funds. If you're looking for a sensible and balanced way to deal with all the many options you face as an investor, then multi-manager funds could be something for you to put in your shopping trolley.